What to know before you buy a multi-let property investment? I think that the first thing that you need to know is that it's a completely different strategy on its own, right? Often it's compared to the buy-to-let strategy, which I know there's similarities, but I think they are fundamentally different. The buy-to-let strategy is you have a house or an apartment or a unit, and you have one family, one person, or one group living in that household. It tends to be your lower risk kind of investment, but also lower returns. So you kind of expect to make monthly profits if you're going the cash flow route of about $1,000 per month, and your return on investment is sort of 6 to 12%. They're easy to do and they're easy to manage. Now, your multi-lets, this is where you have multiple people, multiple families, multiple individuals. An example like student accommodation, you have multiple rooms designated to various people. They are higher risk. It's a higher risk strategy in general. You've got more opportunities for maintenance breakdowns. If you've got 10 students living in a 3-bedroom house, there's going to be more maintenance requirements than if you have a family with one child. So you have to obviously factor those things in. But your returns also tend to be higher. And this is why I think a lot of people are drawn to multi-lets, because you're buying a bigger asset and you're getting a bigger profit load for less work. So your returns, I would say on year one, realistically will be 10 to 20%. With about 5 to 15,000 in cash flow. Those are the deals that I specialize in Joburg South. Obviously, you'll find your own way. Now, in terms of the multi-let, I think there are different kind of transformations or sub-strategies under multi-let. For instance, you've got the HMO strategy, a house of multiple occupations. This is where you have a house and you designate a small room to each individual. And this can be short-term rentals like an Airbnb strategy, or it can be long-term, but you have multiple people in a house. Student accommodation is a great example of a multi-let, and I think one that's very lucrative. In fact, I've just moved forward with a student accommodation purchase in Cape Town, so it'll be my first investment in Cape Town, an observatory, and it's pretty much fully occupied. Despite what's happening in COVID. So that's pretty cool. Then you got the blocks of flats. This is where you're looking at, sort of 4 to 16 units in a building. So they're not massive skyscrapers. You're looking more at your smaller multi-let region. That's probably my preferred and my favorite strategy because they're really lucrative. And then you've got mixed use, a bit of residential, a bit of commercial, maybe some retail. They obviously have their own risks, but they also have their own returns. In terms of my specialization and what I'm comfortable talking about are the bottom two, blocks of flats. I have tons of investments there, and I have some exposure to student accommodation. I haven't really done the above two strategies as much. Okay, for those of you who don't know me, and I'm sure that almost all of you guys do, but I have to have this slide on every time. I have been investing in property for 5 to 10 years. And I've built quite a portfolio within the multi-let region. For those of you who have been following me, my book is live, fantastically so. This is the copy that I got as an author. It's a very cool feeling. So it is on Exclusive Books. You can also pre-order it by clicking the link below. It'll take you to the Exclusive Books page. Fantastic. Okay, I've done my self-promotion. Let me have a little glassy vein. And let's get into the meat of why you guys came here tonight. So this is what we're going to look at: how to find a good multi-let area, how to determine the hidden. Many people don't know what the hidden costs of buying a multi-let are. The finance options and restrictions, I can tell you, they're not as easy to get financed as a buy-to-let. And then I'll show you an example of a deal that I've just signed off on or just done. How you say it? Okay, how to find the right area. It's a very, very, very simple process. It's called your gross yield calculation. And your gross yield indicates, okay, it's not a metric you make a decision on. It's an indication that an area might make sense from a rental perspective. So the calculation is really simple. You take the annual rent that you can achieve within a property and you divide it by what you're buying it for. Times that by 100, it gives you a percentage. So the annual rent, so monthly rent times 12, divided by the price of the property times 100 will give you your gross yield. So let's take an example. Let's say you're buying in a suburban area where for a 2-bedroom property you can get 10,000 Rand rental. So that gives you a gross rent of 120,000. Divide that by, let's assume you purchase it for 800. 120 divided by 800 times 100 gives you 15%. So this is a really clever calculation because it's going to tell you very quickly on the surface whether this deal has enough rent to cover the expenses. In my experience, anything below 15%, you're probably not going to get positive cash flow. You're going to have a shortfall and you're going to have to fund the property. I believe that there is a market for that, but I like the cash flow positive where, you don't get a shortfall, you actually make a profit every month. And if you've got a 15% or more yield, that tends to be the case. Now, your gross yield tends to be higher in lower income areas. If you look here on the right, this is in Midrand, Waterfall, high income suburban, the rent just does not keep up with the capital appreciation. So buying there, you're most likely going to have a shortfall. Buying in your lower income markets, your CBDs, your inner cities, your likes of Rosettenville in the Joburg South region, that's where your cash flow sits. Here's a quick example just to illustrate that. On the left here, we've got an apartment in Krugersdorp. You can see that the rent is 7,000 and leaving with a cash flow of 2,152 at a purchase of 300,000. On the bottom right here, we've got a new build in Greenpoint, Cape Town, where your shortfall is 14,000. Now, these are two extremes, but I wanted to show you an extreme example because your cash flow sits with the lower income market and your capital appreciation sits here in your Greenpoint upper income markets. Here's an example of a couple of areas that I've been investigating. You can see Berea Flats sitting at 23% gross yield. If you're looking at Brixton, it's a student accommodation market that's 24%. Forest Hills 15. Fourways, right? Fourways is more your suburban area, gross yield of 10%. Anything under 15 is going to be negative cash flow. So in that area, you're going to have to fund the shortfall. So you can just see these are areas that I've chosen specifically because they make financial sense. Now, instead of spending hours and hours and hours on property 24, I can just quickly understand what are the average prices, do the gross yield, and then find the area that I'm most comfortable with. You have to research your area and know whether it makes enough financial sense for it to work. For instance, I had a look at two areas within Cape Town. I wanted to start looking at student accommodation. So here you can see a comparison between two popular student accommodation areas in the Cape, which is Stellenbosch, and then your Woodstock, Observatory, Rosebank area in the southern suburbs. Now, in terms of the gross yield of these two deals, you can see it's a lot more lucrative to work in the Woodstock Observatory market. And the reason is because the value of the properties in Stellenbosch are too high for the rent they generate. You can see here that the Stellenbosch property, this one in particular, is only generating 34,000 for a 3.2 million Rand purchase. The Woodstock is offering a 50,000 Rand rental for 2.5. So you're getting significantly more rental, plus your purchase price and thus your bond repayments are less, leaving you with a bigger gap, which is the cash flow. So you got to know your area. For those of you who are interested in learning more about the detailed multi-let space, I am running a mastermind session next week, Thursday, for 2 hours, plus then an hour of networking afterwards. It will cost 300 Rand to register unless you are a member of the Property Bootcamp. Then you can attend for free. And in that workshop, I will be taking you guys through some more practical exercises. So it's only 20 people that attend, And yeah, essentially giving you some tools, giving some practical examples. We will be analyzing 3 areas, sort of the first 30 to 45 minutes of the event. Okay, let's quickly go to some questions. Okay, Kanya, my main concerns before buying a multi-let are zoning, if power in each room is prepaid, and if it has existing tenants. Okay, I agree. Okay, so let's go point by point. Zoning, it depends on the strategy. If you're going student accommodation, yeah, you're gonna have some requirements to meet, especially if you want to get NSFAS kind of students, NSFAS, which is the National Student Funding Association, something like that. They fund students. If you've got a block of flats, you need to get it sectionalized and turn it into a sectional scheme. That's 60, 70 grand. It could take 12 to 18 months. So you have to include that in your finances and in your projections. I agree with point 2. I would never buy a property that doesn't have prepaid, or at least I would budget to install the prepaid, which is not significantly expensive. You're probably looking at 5 to 10 grand per unit. And then if they have existing tenants, I agree. I want to see proof of payment trends. So if they've got a rent roll for 6 months and I can see the tenant payment behavior, that's really what I'm looking for. So I agree. If it has existing tenants, and then looking at the okay, so here we've got, good evening. How do I manage water utility in a multi-let? Another good question, and something I will touch on just now. In multi-let, you've got variable costs, which means your electricity and your water are consumption-based. The higher the person uses the electricity, the more expensive it is. So if you've got 10 students all using their heaters and electric blankets over the winter months, your expense will skyrocket, your electricity expense, leaving you with likely a negative cash flow. So prepaid meters are probably the best way that you can resolve this issue. By putting in prepaid electricity and prepaid water meters, it's easier for you to manage. So that's what I would say in terms of water. Water is not always that expensive. The only issue I've had is a couple of years ago when I had a multi-let, there was a toilet leaking, and that ended up costing me like 20 grand over 3 months because I didn't get it stopped in time. So that's for me what the issue is. Masejo, it's currently in the bookstores, exclusive books, yeah. And then is there a recording of the session? Yeah, there will be 100%. Okay, guys, keep the questions coming. I am going to move on to the second part of the agenda. And I think this is a really, really important part, because if you don't know all the costs, you can't make an informed decision. And oftentimes what we get is the top of the surface, the advertised price, and all the hidden costs below it, which actually end up killing the deal, we're not aware of. All right, so we have to know what these hidden costs are in specifically a multi-let environment. So I decided to just look at an example. This is a really nice block of 6 units in the Rosettenville area. On the surface, the deal looks very attractive. Here's the description that the estate agent's given me, with a net return of 15%. I'd like to understand how they got that exactly. Fully let and well maintained. Again, I'd like proof of that. We've got rates and taxes of 2.4, and then it's in really good condition. No need to make any kind of renovation estimates. So this is the only information we're given. And based on this information, what most people would do is they'd break down the numbers like this. Using the rent of 31,000, a bond of 18, the rates and taxes of 2,400, leaving you with a cash flow of, just over 10,000 Rand and a return of investment of 19%. On the surface, it's a no-brainer. It makes sense. That's what's been advertised by the agent. So that's how we've, analyzed the deal. But they're missing 5 of the hidden costs. Now, if you've got a pen and paper, just make a note of this. Otherwise, just take a screen grab of this slide, because this is critical. Number 1, vacancies. Vacancies. For instance, the student accommodation market you're almost always going to have 2 months where you have zero rent. November, December, when the students take leave, they go on break. Obviously now with COVID, I think everything's shifted on, but there's still 2 months of the year where a student does not rent. Now, if you can rent it out to an Airbnb, that specific property, then you can recover those losses. But if not, you have to make sure your numbers work on 10 months, not on 12 months. So that's where I would then allocate a vacancy provision to say, 16% of the rent that I receive, I want to allocate to a kitty, because that's going to be my void and maintenance budget for this deal. Operating costs: water, electricity, and maintenance. The most expensive cost from a maintenance perspective with student accommodation is door handles. Replacing door handles and changing keys, replacing keys. Because most doors are opened once or twice per day. When you're in a student commune and there's 17 rooms and each one's using the same door, that key and that door is being used 17 times, completely overused, and thus high renovations. But that, you see, if you don't know this, then you don't know how to budget and cater for it in the numbers. So that's your operating costs, your water and electricity, and then your maintenance and repairs is really important. Insurance. I think it's absolutely critical. I would feel very uncomfortable if I had a building without any insurance. If it burns, if there's some sort of disaster and the house is burnt down, at least I get coverage that they will rebuild the house, and they'll also look after the geysers. They'll give you a whole comprehensive plan. You can even get rental insurance, which is really interesting. And then zoning, right? How much does it cost to sectionalize, to subdivide, to register as a commune or for Res 2 mixed use? How long will it take? Tough questions to put answers on, but these are the costs that you have to try your best to uncover, and then you will be, have a much more realistic perspective. So let's re-look at this deal now, but include the missed cost that we didn't have. So first of all, vacancies. Based on what I'm seeing, I know Rosettenville, and maybe if I see 1 or 2 rent rolls, let's put 10% vacancy aside. So 10% of the rent I'm going to be putting away into a savings account, and that'll cover poor months where I lose tenants or have to do evictions or that kind of thing. OPEX, your operating costs, water, electricity. It's usually included in the rent unless you've got your prepaid meters. So that's why prepaid meters are critical. Repairs, I would usually put a bit of a budget aside every month, 2, maybe 3 grand, for cleaning service, garden service, and then every now and again you'll have to change a geyser, or a tenant moves out and you'll have to repaint the place. There's general wear and tear. So you put a bit of money aside for that. Insurance, for a block this size, just to get comprehensive building cover, you're probably looking at 600. So in truth, when we take everything into account, it's not 10,000 Rand cash flow, it's just under $1,000, leaving you with a 1.41%. And unfortunately, a lot of people then buy on the first slide. They buy on the assumption that, I'm going to be making 10 grand per month. And then all of these hidden costs or these unknown costs that you weren't aware of going into the game set you back. I'm currently going through my first sectionalization of a block of 9 units. We're estimating about 90K in total for the architectural work and also the town planning work, and probably a 12-month timeline at best case, maybe 18 months. So once I do have that detailed information, I can let you know. But these are the costs that you have to be aware of, guys. As further proof or further example, let me show you the variable nature or the volatile nature of OPEX. So here we've got a pie chart which is detailing the percentage of my different expenses on a given building. So you can see that of my total expenses, about 11% is going to rates and taxes, is going back to the government. 5% is allocated to insurance, and 13% is allocated to utilities. My 2 greatest expenses, water and electricity, are the variable costs. Those are the ones that fluctuate with use. The others don't fluctuate. So about 75% of the expense base that I have is being allocated towards a cost that could fluctuate. That is the need for electrical meters. So I definitely recommend, and I always invest in getting prepaid electrical meters. Regarding water, what I tend to do is I tend to push that back onto the client's or the tenant's account. So at the end of the month, I see what the bill is for the total water spend for the building, and I divide it equally between the tenants, and they have to pay that in addition to their rent, which is relatively common in the area that I invest in. But in the low income market, that tends to be the case. In terms of the mastermind next week, just because I don't have that much time with you tonight, for those of you who are really interested in getting into the detail and doing some practical examples, this is maybe an event for you. So the practical exercise will analyze 2 deals together, and then each person on the call will go and analyze their own 2 deals. So it'll be pretty cool. Guys, basically don't trust the advertised price. You have to understand the hidden costs, because otherwise you will get stuck with a subpar investment. Instead of getting the 10 grand, you get the 900. It's not great. Okay, let's take a quick break and look at some questions. What if the owner receives cash, then bank deposits if the property you want to buy? I'm not sure I understand the question. What if the owner receives cash? No, I don't understand the question, Sabina. Could you maybe ask it in a different way? Masejo, do you believe doing a course at CPMD is a good idea to increase knowledge? So what is the CPMD? When calculating their net effective yield, at which point will I know how much bond repayment rate or percentage the bank is willing to give me in the case that I'm looking for 15% deal? Masejo, I would just use pretty much 70 or 80% loan to value. That's conservative. You're most likely going to get that. And then I would use 9.5% interest. Again, you're probably going to get 7%. The last couple of bonds that I've gotten were all 90, 100% and prime minus. So right now the banks are wanting to lend. Okay, do you think a good area or a good property is more important? If a good property is more important, then should you limit yourself to a particular area? It's a good question. I was always told that you should find and buy the worst house on the best street. And I think that's quite an interesting concept, because the best street is going to appreciate, it's going to be popular, it's going to be in demand, and the worst house is the biggest opportunity. If you can go in there and fix it and bring it up to the level of the rest of the street, you've naturally increased the value. So I don't know, it's a good question. I think area is more important because you'll find more properties, but I guess to each their own. Lindiwe, what is a decent amount of prepaid electricity to provide before getting people in the multi-let to provide for themselves? Okay, so Lindiwe, what I tend to do is with students, I will give them a budget, and I'll say, I'll spend 1,000 Rand every month at the beginning of the month, but when you run out of that, you have to fund yourselves until the end of the month. So that's what I would do with students. You give them a bit of a budget, maybe like 100 Rand per student or 200 Rand per student per month, whatever you decide. With professionals, or when I go blocks of flats, no, prepaid, and they must cover it from the beginning. And that's just the way it is. Joanne, how do you work out the market value of a multi-let property? The same as you would with a buy-to-let or with a flip. Your best approach is to go Lightstone or TPN and get their property evaluation reports. That'll show you what's recently sold in the area, and will probably give you the best idea. You can then compare that with Pocket Let, and you can also maybe phone 1 or 2 agents to get a sense. You can also look at the municipal bill, where they'll have the municipal valuation, but I don't really trust the municipal valuation, to be honest. I just think it's always too out of date. Okay, I'm going to answer 2 more and then continue. Is it good if a property has a net yield of 5.10%, but a gross yield of 20.10? Yeah, so those are 2 completely different indicators. Your net yield is your net cash flow divided by your purchase price. Your gross yield is your gross annual rent divided by your purchase price. So They're two completely different calculations. I like to work on gross yield. So 20% gross yield is fantastic. The net yield, you've got to compare, you've got to compare apples with apples. So you either choose the net yield or the gross yield, but they have no real correlation and they won't ever be that similar. Is a body corporate even in this case or deal? So that's an interesting question. So the buildings that I specifically like to buy are the ones that aren't sectionalized, i.e. there is no body corporate. But the banks don't like to lend on them because the bank sees it as a commercial asset and therefore they give you commercial rates, and they give you bad interest rates and it's just it's expensive finance. So the approach that I've taken is to buy these buildings cash. So bring partners together, bring some angel investors in, we buy a building cash, we sectionalize it, so we turn it from 1 title deed into 6 title deeds, and then we go and get 6 home loans from the banks and from different banks, and we turn it into a body corporate and we manage it as a body corporate. So as soon as you sectionalize and you turn into a sectional scheme, body corporate, you have to legally install or put in place. So yeah, that's definitely, it's not in this deal because it's not yet sectionalized, but as soon as it is, that'll be. Okay, guys, great questions. I am going to continue with the slides and then I will go back to the questions in about 10 minutes. Okay, so how to finance a multi-let. This is the tough part, guys. So bank finance is an option, but as I've just mentioned, as soon as you go there with a building, they're going to say it's commercial. They're going to give you a 10 to 15 year payment period, and they're going to charge you interest of 12% or prime plus 3, prime plus 4. And it's only going to be a 70 or 60% loan to value. So you're going to have a lot of cash to do bank finance, and your cash flow is going to suffer. JV partnerships and angel investors is probably what you want to be working on. The ideal scenario in my case is to buy it cash and then over time show the value to the bank and then be able to get competitive finance on that asset. My belief is to not look at the banks, but to leverage partnerships, to leverage what we like to call OPM, which is other people's money, which is lovely. So here's an example of the most recent multi-let that I'm invested in. It's a multi-let or block of flats called Great Court. It's a 6 3-bedroom, asking price of 2.8, offer price of 1.9. So we've signed, we've already paid deposits. We're now just waiting for the process of transfer. In terms of how the cash works on this deal, I've got 4 partners together. We split the costs. And we basically bought this property cash, right? So in terms of the inflow of cash from rental, you're looking at 30 grand. Outflow, let's call it just under 9. And they're just broken down into your hidden costs, your management fee, insurance, maintenance, voids, or vacancies. Walking away with a cash flow of 21 with a total investment of 2.3. So that 2.3 is what me and my 4 partners needed to come up with. Now, when you're bringing in JV partners and you're bringing in these people who are going to help fund your business, you're going to have to offer them shares. That's what they're going to want. They're either going to want a loan agreement where you give them, 7, 8, 9% interest on their money and you hold the money for 3 years or whatever you decide. You can do a loan agreement. But in my experience, most people who are going to lend money to you want to have equity. They want to be partners in the deal. They want shares. Now, the easiest and probably the most fair way to allocate shares is to say the amount of capital you put in is the shares you get. So you're putting in 10% of the capital, you get 10% of the shares, which is meaning 10% of that profit at the end of the month is yours. Something that I tend to bring into these conversations as well is sweat equity. As the jockey, as the person running this business, I'll be finding deals, I'll be managing the agents, I'll be getting the discounts. As the person who's basically running this deal, that needs to be valued as well. So when you're looking at my remuneration and my shares, what I'll do is I'll say my capital plus the value of the sweat equity that I brought to the table will give me my allocation of shares. So I don't have to bring that much capital to still get a good share of the business, because I'm bringing in all the value. And all of my partners thus far have understood and have said that's fine. If you're going to be running this business, you should be remunerated. So yeah, this is a cool deal. Now let's look at how the financing worked on this, because that's where the value is. Now remember, this is, although 6 units, it's on one title deed. So the way it's registered in the deeds office is that this is one property. Okay. So what we've got to do is, working with an architect, we've got to be able to create approved building plans and get basically, get it to a town planner who will then approve the process of turning into a sectionalization. So step 1 is to get the architect who does the drawings and all of the approvals. And then you've got the town planner who registers it with the municipality. Once you've got these 6 units, you approach the banks. Now, the likelihood of Nedbank giving you all 6 loans is very low. The banks don't want to have all of the properties in a sectional scheme. They want to have a few. So this is where you approach the banks and you let them work against each other or off each other. So you get 2 with FNB, 2 with Standard Bank, 1 with FNB, 1 with ABSA, and 1 with Nedbank. And you just find the most competitive rates, and you refinance, take all your money out, you pay off your partners, or you go and invest in a new deal. And then you can get 6 home loans at the home loan rate. So 90% or 100% loan to value at 7% interest over 20 years. Then it works out. As a proof to the pudding, this will be the numbers once we've refinanced. So in the next 12 to 18 months, once this great court has gone through the sectionalization process and we have approached the bank, this is what the numbers will look like. So you'll see that there's a big expense item now called your bond, right? That's obviously the bank's money that we need to pay them. Our cash flow is substantially less. It went from 21,000 to now 4,500, but our total cash in the deal also went down a lot. So in the beginning, we had to put 2.3 million Rand into this property. After we refinance, we're only going to have about 300, 350 left in the deal. So we can take the 2 million that we've made off this deal and go buy another one, sectionalize, pull out the money. Then go buy another one, sectionalize, pull out the money. And in that way, you're leveraging, recycling your money and reinvesting it to buy assets. So that's the strategy. I know I'm probably making it seem easier than it is. It's really tricky. I mean, to find investors, to get them to believe in you. I've been doing this now for 8 years, and only in the last 2 years have people actually started partnering with me. Before that, the first 6 years, I was hustling, using my salary and using my savings to try and buy properties, and now I can leverage other people's money. So yeah, guys, that's a key part of this multi-let game. Another deal that I'm doing is a student accommodation here in Observatory, Cape Town. And what I've done is me and 3 mates, young people like myself, we've split the deal 4 ways. So we got 100% loan to value because we're all employed and all 4 of us have a good salary. And we've only had to put down the buying cost, which split between the 4 of us is 50,000 each. So with 50,000 from 4 people, that's 200 grand. That's the buying cost and everything regarding the registration. And now we own a property that cash flows positively and has been 100% financed by the bank just through leveraging partnerships. So I think, crowdfunding, stokvels, I think that's the answer to a multi-let. That will be the last part of the workshop. We will be looking at how to find and finance your multi-let deals. I got about 60 leads from my letting agent of properties that are on the market but are being sold. So we will be using that spreadsheet in the workshop. I will be taking you through a couple of off-market leads and showing you how you can analyze a deal before it comes onto the market. And obviously that makes a lot of sense because you're getting there before the general market can get there to try and bid for the property. Here's a nice little testimony. I got this email, as you can see, on the 10th of August. So I think it was yesterday or the day before. Khutso is one of my old students. I mean, she's just an absolute machine. As a CA, a CEO, a full-time mom, and businesswoman. It's fantastic. And yeah, she's doing multilet. She's on her third multilet now. She got bank approval from Mercantile Bank. That's pretty common. You're not going to see your ABSAs and your standard banks lending on a multi-let very easily, or a commercial building very, very easily, unless it's sectionalized. But your smaller banks, your Mercantiles, your Tufts, your Sentinel Homes, they might. And the great thing is what she's building equity. And the great thing about Khutso is her portfolio is growing, and she's gaining equity, which that's the long-term play with property, right? I like the cash flow positive from day one. I want the tenants to pay off the bond and all the expenses and to run profitably from day one. But I also want over the next 10, 20, 30 years for the value of the properties to increase, and thus my equity and thus my wealth to increase. And that's the great thing about property, is you get both. Okay, so last reminder, if you do want to attend, it's 2 hours next Thursday. There are only 20 people coming or available, and yeah, if you're a member of the Property Bootcamp, just let me know and we will get you organized. Also, if you're a member of the My Property app, send me a message or let us know, and we will ensure that you get a free pass. Okay, let's go to the question. I see there's lots of questions here. Carly, do you think Joburg would be a good place to start with multi-lets instead of Cape Town? No. You know what? It depends. If you're a starting investor, let's say you're doing your first deal, I would say wherever you live, start there. To try and buy a property in Joburg when you're living in Cape Town, although it's possible, if it's your first one, I would say that's no. Then you definitely need a coach to help you through that process. But I would say try and invest where you are. Multi-lets in Cape Town work, but it's more your student accommodation coupled with your Airbnb strategy that works really nicely. Joburg just has a bigger population and more demand for low-income housing, so it tends to work really well there. But I've seen places in Eastern Cape. I've seen in Mpumalanga. I've seen provinces all over where students of mine are doing multi-lets. I mean, North Riding, I've seen a couple of multi-lets come up on the North Riding side. So, there isn't just one place where it works. Sabelo, do banks finance multi-let, and what are their requirements? So as I've mentioned, the banks, they don't really finance. What they will finance is maybe 70% of the value at over 10 to 15 years. Which is going to kill your deal. So this is where the cash component comes in. Kanya, banks don't like multi-lets, and Tough is no longer doing areas like Melbourne, Jeppestown, and Denver. That's interesting. Because Tough is all about urban development. So why would they be avoiding those areas? They probably know something that we don't. Maybe have a look at Berea, Joburg CBD. I know it's a pretty safe area. Braamfontein, cool areas that Tough I know are looking at. Busi, how do you value sweat equity? Yes, that's a good question. It's tough because I might think my time is more valuable than someone else's time, or they might think that they're more valuable. Like it's a tough question. What I can say for the Great Court deal, how I justified the sweat equity that I got is through the discount. So the value of the property, or the market price on property 24 was 2.9, and we got it at 1.9. So that was essentially almost R1 million discount on what they were asking. And I said to my partners, guys, that's a discount you wouldn't have been able to participate in if it wasn't for me. So give me, let's say 200,000 is the value of the sweat that I'm bringing because I got us R1 million discount. So that's like a way you could justify it, but it's hard to know exactly what your sweat equity is going to be. Justine, I want to turn a house into an HMO. How do I cost effectively manage water and electricity? Is it possible to install prepaid? Yeah, 100% possible, not even that expensive. Water meters, I wouldn't say you need to install water meters necessarily, but electrical meters definitely. Water meters, your water expense is not usually that high unless you've got a leak. And then it's something that you want to, because the thing is, electricity fluctuates a lot with weather. Water doesn't that much. Also, if you have baths, I would say get rid of the baths and put in showers. How do you manage tenants breaching electricity and water meters? So do you mean like when they break them, or if I'm not sure what you're asking here. How do you manage tenants breaching? I assume breaking electricity and water meters. You can have an insurance in place for that, but most of the tenants aren't going to break electricity and water if it's servicing their, servicing their units. It might only be if someone breaks in and then damages that you might have to replace it. Sia, who is? I don't know. Sorry, I don't know what that is. Lara, what do you do with the property while you're waiting for the rezoning to be completed? So you just rent it out as is, The thing is, there's nothing illegal about buying this building. It's just, it takes a year or so to register with the municipality that you want to turn it into multiple title deeds. So, while the rezoning is happening, we're just renting out as normal. And then as soon as the rezoning takes place, we can then go and approach for finance and release our equity. In that meantime, we just have to leave our money in that deal. Okay. Sia, are the zoning costs dependent on building size and area? Please explain zoning. Okay, yeah, so very much dependent on the area you're investing in, the size of the building. I'm doing one now of 9 units, and it's probably going to cost us 60 to 90 grand. So you're looking at probably about 8 to 10 grand per unit, roughly. For those of you guys who have asked about joining the practical workshops, you can just click this button here below. It'll take you to the registration page. If you're a member, you first need to log in and use the membership pass that I sent on the WhatsApp group. Okay, Nazir. Would you operate as a property investor in your own name or open in a company? Almost always open in your company and have a trust own shares in the company and then the company to own the properties. That's the ideal structure. Definitely not in your personal name. Definitely not. I want to turn a house into an HMO. How do I? Okay, we already spoke about that one. Busi, why do banks have a problem financing a multi-let unless it's sectionalized? Because in their mind, it's more risky. And with higher risk, the bank has to compensate with that, and that's why they give more strict terms. I don't know why they see it as a risk. I mean, the rental that you're getting in these multi-lets is much higher than a four-ways flat or a suburban flat, but yet they loan on that. I don't know. For me, it's strange, but it's the requirement. Masilo, who exactly would I have to go to in order to change the zoning, and how long does this procedure take? So who you have to approach are 2 people. Number 1, you need an architect. The architect is the person who can understand the building, can draw up the plans, and get the municipal approvals. Then you've got the town planner who's working within the council. They are the people that can go and get the legal registration done. So those are the 2 parties, your architect to do the drawings, your town planner to do the registration process in the council, and those 2 together, they'll charge you separately. In terms of how long the procedure will take, to be honest, I'm doing my first one. So I'm guessing 12 months will probably be the case. That's what I've been told by the architects. Guys, great questions, man. I'm loving this. Do I need to buy these in a company or own name? It is more difficult to get a loan from banks when in a company. So you want to get into a company. I don't think you want to be buying in your personal name. Trust me. And also when you buy in your personal name and you want to then put it in your company name years later, you're going to have to pay transfer costs again. You're going to have to sell it into your company's name. It's a mission. It is more difficult to get a loan from the banks. In a company, you have to provide more documentation. There's a bit more admin to it. But what you can do is you can put your bank in the front, but then you can give personal surety to the bank. So yes, they're learning on the company, but if the company defaults, they can still go after you, the person, and then that pretty much, diffuses the risk for the banks. To be clear on question about bridging meter, it is to bypass the meter to avoid paying electricity. Oh, so what do you do when tenants are bridging the meter? That's a good question. I haven't had that happen to me before, but I use a third party, a company that always does the electrical meters. So they basically monitor and manage, the electrical meters for me and provide me with a report. And actually just today we had to turn off one of the tenants' electricity boxes and reinstall them because it wasn't working anymore. And they went out and they just checked that every unit was fine. I guess maybe when I get that experience, I'll be able to share it with you. Let's see here if there's any other questions. I don't see any other. Oh, wait, here we go. Justine. With a HMO that already has existing electrical meter, how does one connect the prepaid meters? Well, if it's already got an electrical meter, then that's fine. And then as you take ownership of the house, you just need to continue that contract with a third party, with the electrical provider. So if there's already meters in place, then you don't have to worry about including it because it's already there. Lawrence, do you make use of agencies for tenant placements? Dude, it's up to you. You can graft yourself and you can save a few bucks. I'm of the belief that I always use a managing agent. Managing agents know the area. They know the contractors. They have their attorneys and everything in place. I live in Cape Town, invest mostly in Joburg. I don't want to now, how do you do an eviction if you're so many kilometers away? And also most decent letting agents will follow the right kind of procedures. They'll do a vetting of the tenant. They'll get a credit report. They'll make sure that they're employed. They'll check the 6 months bank statements. So they do a lot of that vetting for you because they want to place a good tenant because their rent or their income is in relation to how much rent they collect. So if they don't collect any rent that month, they don't get a management fee because it's 10% of the rent collected. So they're incentivized not only to manage good tenants, but to place good ones in the beginning. Awesome, guys. We've got another sort of 10 minutes. I'll give you some more time to think of any last questions. While we wrap up, I just wanted to quickly do a mention of our membership. Sorry, I know I am presenting a lot of products, my book and the webinar, the mastermind, and now the membership. I don't usually like to sell this much on these webinars, but I just wanted to make you guys aware. The property membership, if you want access to our portal of a whole bunch of templates. So we've got NDAs, acknowledgement of debt, shareholders agreements, offer to purchases, all of these legal templates that you can download, reuse, etc. Business templates, so spreadsheets, due diligence templates, how to create a business plan, all of these different elements that will help you start your business. And then also some financial templates with some advanced online content. So the stuff I have on YouTube is obviously free and accessible to anyone and everyone, but I also have some advanced content with some quizzes just to really help you grasp the content. And yeah, we also have a private forum and an investor network. So go have a look, 3 membership options, 100, 200 per month, or if you want to become a lifetime. That is it from a selling perspective, I promise. Like I said, I'm just grateful to have a chance to do these webinars, share my knowledge. I see a lot of repeat people coming back, and that's a good sign for me. In some way, I think you guys are getting some value out of this. I see another 2 questions have popped up. Okay, Edgar. With Wi-Fi, how do you distribute it equally to tenants? Example, in a student accommodation, you don't want one student clogging the network by streaming Netflix, for example. Look, when you're looking at Wi-Fi and you're in the student market, you need to pay for the best possible service, because I can tell you now that if the students aren't being able, especially with COVID and especially with online learning, if they can't easily access the internet, they are going to leave. So I would rather pay for a premium version of the Wi-Fi to make sure that it's really accessible to all the students, because I know that extra 300, 400, 500 Rand is going to spare me a lot of aggravation later on. You can put limitations. I'm sure you can speak to an IT guy or Web Africa. I'm sure they'll be able to allocate certain amounts of data per IP address. I'm sure there's ways around it. I'm not an expert, but yeah, I'm sure. Under hidden cost, there's expense. Who is expenses? What is who is? I don't remember seeing that. Let me quickly look at the slides. Sorry, I must have made a mistake. I don't see it. Maybe in the replay, you can go and have a look and then send me an email. I still don't understand the question. Akram, do you have a good property management companies that you can recommend? That's pretty location dependent, to be honest, Akram. So if you're going Joburg South, I like Landstar and also like Tupa. Those would be the two managing agents in the south of Joburg that I think work well. In your CBD of Joburg, you're looking at your Trafalgar. Actually, Trafalgar is pretty nationwide. I would say that's probably quite a reliable, that's a big beast. It's a big company, lots of experience. But it's very much location dependent. So depends which area you choose. I would go there and I'd understand who are the experts in that market. That's kind of how I stumbled across Landstar, just by starting in the area and then researching around. Are there any letting agents who don't require holding in the deposit's tenant, the tenant's deposit? So obviously, when you get a new tenant, you ask for a deposit. This is to cover any maintenance issues or any lack of payment or whatever it may be. Some letting agents won't get a deposit. I think that's silly. Obviously in your low income market, you have to be flexible as well. You can't ask for 4 months deposit. Sometimes you have to ask for 2 weeks deposit, in order to secure the tenant. So it's a negotiation between you and your tenant more than anything. Are there any letting agents who don't require okay, sorry, I think I asked that. Would you recommend a biometric system for access to a student housing building? Sure, I think the cost is heavy, but that might give the parents peace of mind, and the parents might be willing to pay a premium price. So I'd market it as highly secure and try and bump up the rent. If you can bump up the rent by 500 per person, then maybe the cost is justified. But to put a biometric system in place, you're probably looking at like, I don't know, 10 grand, 20 grand. I've never done it, so I don't know if the cost would be worth it. So RT, you can go to propertybootcamp.coza, or you can just click this little green button. It will be available in the preview, in the replay. Can you recommend a property inspector company in Cape Town? I can't yet. I'm still really new in the property space. I did have a builder come and look at the student accommodation property that we're buying. I wouldn't call him an inspector. It was more just a friend of mine who, has got some electrical experience and, has done some small renovations here and there. And he just gave me a bit more of a detailed idea. But right now, I don't have an inspector in Cape Town that I can reliably say, go check him out. Okay, last question. What's the best strategy when negotiating below market value price on the property? Best strategy is to find motivated sellers. Simple. If you're trying to negotiate a good price with someone who's not motivated, doesn't matter what negotiation techniques you use or what psychology you try and bring into it. Nah. If the person isn't motivated at your price, you've got to move on. That's probably been a hard lesson for me to pick up. I've tried to force some deals because I'm so desperate and I want the deal. You know what? If you don't like my purchase price, just move on. For student accommodation, what kind of geysers do you use? Gas, solar, electric? What are the pros and cons of each? So, I think solar is a great concept. I think there's obviously savings to be had. But the trick with solar power is that it's a large upfront capex cost. So yeah, you save money on a month to month, but you have to pay that upfront when you install the meters, install the panels. So I kind of just take over what I've bought. So if there's gas in place, just continue with that. I'm not necessarily looking at changing that up. I don't see the cost benefit yet for going solar unless the government brings some sort of like green tax bill, which I think would be really exciting. that the government is looking at ways to tax people who aren't green or who are carbon expressive. Yeah. I think with that, I might call it an evening. It is 6 o'clock. Not 6 o'clock, 7 o'clock. Time flies when you're having fun. Thank you once again for joining. Please, guys, I know I've done a lot of selling today. I know it sucks, but please do go and get yourself a copy. Millionaire in the Making. This is my jam, my dream, my love for life is to write. And I actually just got news from Penguin today that they want me to write another book. So my dream of becoming a writer is slowly molding into reality. The recording will be available. Please do try and attend the workshop next week, the mastermind. Otherwise, until next time, happy investing, and I hope to see you soon. Cheers.